We've been in a situation where the market has front run the Fed several times over the course of the last several years. It winds up getting too aggressive. We got too aggressive on the hiking. The Fed had to slow that down. Then it's gotten too aggressive on the expectations for cutting. Earlier in the year, as we entered the year, the market was looking for 6 rate cuts to start the year, and then reduce those throughout the course of the year as the economy held up better than expected and inflation was stickier for longer. But as we've pushed through into the third quarter, we're finally at a point where the economy is starting to show signs of strain and show signs of slowing, and inflation does seem to be moving more rapidly down to target. And so the question is, are we just going through, a mid-cycle correction in the economy, in which case the Fed can kind of pause easily and slowly and methodically and prevent us from cascading into something more sinister? Or is it already too late? Did they keep policy too tight for too long, and that the economy is really rolling over and that they're going to have to react aggressively over the course of the next few meetings? And so, look, I think at this point that the markets are expecting the Fed to react aggressively to an economy that hasn't yet proven or shown signs that it really needs that level of accommodation. And so right now, you have a market that is looking for 9 to 10 rate cuts over the course of the next 15 months through the end of next year. And as of the last Fed dot plot, the Fed was only looking for 5 or 6 cuts. So the market is way ahead of where the Fed said they were going to be as of 3 months ago. We obviously get another look at the Fed's dot plot at this meeting coming up in September. But the economy showing unemployment only at 4.2%, up from 3.5% or 3.4%. So that's a decent jump up. But if you look at 75 years of data, a sub 4.5% unemployment rate used to be considered maximum employment. So not clear that the labor market is yet aggressively slowing. And inflation is still running 2.5%, 2.6, 2.7%. We're not back down to 2% yet. So with the S&P close to the highs, with credit spreads incredibly tight, we had an ISM services number this morning, which was the highest in nearly 2.5 years. To me, it doesn't seem like the economy needs the Fed to aggressively start cutting in September. So at this point, I think the Fed's going to be moving forward with a 25 basis point rate cut, but the market's going to be disappointed. And so we're in this kind of weird reality where the economy necessitates one thing, but the market wants more. And so it's a precarious setup, I think, for risk assets, right? When the market is going to be disappointed by the Fed and the Fed's reaction function, that's typically when we get bouts of more risk off. And so I think that's where we're headed here over the course of the next couple of weeks into the Fed meeting, and probably on the backside of the Fed meeting. Also have a pretty seasonally weak period historically. September, October, not been the greatest time for equities. We have some various liquidity squeezes coming with tax payments for September, tax payment in October, quarter end liquidity squeeze. So we also get the share buybacks stop towards the end of September. So the setup, the outlook doesn't look great. And if the Fed's not going to deliver what the market wants, there's scope for disappointment.
A lot to unpack there. I'm going to go through this piece by piece with you. First off, I'm surprised that you think that the market is not going to be happy with just 25. And the reason I say that is because from where I sit and when I look at it, and I'm nowhere near where you are on a macro level, but I look at it just from a reactionary standpoint, I think the market would be like, whoa, the Fed's cutting 50 basis points here. Are things really that bad? I'm almost thinking that would be a more negative reaction than versus, okay, we're cutting 25 basis points. We're playing this smart. 50 basis points to me feels like we're behind. We're catching up. There's things out there that are worse. I mean, what are your thoughts on that argument, saying that the market's thinking that 25 isn't enough?
Yeah, look, I mean, it's a little bit, they're damned if they do, damned if they don't, because they've kind of created this environment where risk asset and investors continuously front run them. And so it's almost, in this case, the market has front run the front run, right? I mean, I think what will wind up happening in the environment where, let's say this payroll number comes in okay, and we start to price out some of those rate cuts, you're going to have an environment where yields start to move higher. The dollar starts to move higher again, which is counter to how most folks are set up and currently positioned. And so you've had people plow into defensive sectors of the economy, of the market, staples, utilities, healthcare, real estate have all broken out to highs. And so if we have a situation where yields move higher again, all that recent outperformance is going to come unwound. And then the question becomes, okay, in a higher yielding environment where the Fed is doing less accommodating, where are you going to rotate into? What segments of the market do you really want to be part of? And I think that people will see this as perhaps the last good round of data here in August. Maybe it's the last good employment print. Maybe it's the last good services ISM. So yes, the Fed would only cut 25. There may be some relief that things aren't spiraling out of control. But I think that would rapidly transition to, oh crap, now we're losing money on some of this defensive posture we had. Where do we put our money? The economy still looks like it's slowing. And then the election uncertainty is still growing.